Eric Mwathe with Mwathe.com. Let's take a look at markets here with about 2 hours to go before the close of the day session here, being a Tuesday, short trading week. We see the markets trading close to the highs of the day, Dow up about 210. Want to show you why I personally think we should take the exact opposite view. In other words, we should look at this rally as being very suspect. But before I do that, let's take a look at what could actually be taking place. Of course, we don't know, but we've seen a slight lower low on the Dow with a slight improvement on the weekly RSI. So at the risk of being wrong here, this could suggest that markets are doing their best to build on this weekly chart. Also, you can extend this line like that. So, the weekly is starting to look good. Also, you can take a look at, if you connect the lows here on a weekly closing basis, so the weekly closing lows since summer of last year, we have a nice declining line while we have improvement on the RSI. So week to week, I do respect the fact that yes, the market could actually be setting up to move higher. But I want to show you why I think we should take the opposite view, which is just my own conclusion in the here and now. Number one, if we go take a look at the Dow hourly, we can see reasons why we should suspect that this is a stall point. Take a line connecting the highs on the Dow hourly, and I don't know how clear it can be other than what is in front of us, which is that the market is coming back to test the recent highs, and we are finding it difficult as of right now. We haven't moved above that very easy to identify topside line on the hourly. And also, if we go back to the break of late December, and we know this break in late December was actually destructive for the market because we plunged there in January. We came back and tested the lows of January. And if we draw a line from here, which is a red line, so we can see right now the market is coming back to test those two lines, the red line and the blue line. So my thinking is around here we stop. And also, if we take a look at, let's just take a look, for example, at the NASDAQ daily. In fact, yes, take a look at the, hold on a second here. Let's go to the daily of the, we can take a look at the NASDAQ daily. And we see here that the NASDAQ is coming back to test the previous break level. And this is a big deal. This is a problem I have when people are trying to use price only. Price is very deceiving. You can see here, there was a break. This is sentiment. I think the RSI, in my opinion, is always a measure of sentiment. And if you look at it as a measure of sentiment, and I think sentiment should precede price, you get an idea, or you get a look at the market's hidden agenda. And here we can see that this break right there, very simple line. But since then, instrumental for giving us a high of late January, early February there. And now we are coming back to test that red line. If we can't move above that line in the coming days, then we should expect the markets to pull back from current levels, which means we shouldn't be going long, which means we should still remain bearish. In fact, right now, I think we should be looking for reasons to go short, and I'll share some ideas. Let's take a look at the Dow transports, which are having a fantastic day to the upside. But remember, markets are full of tricks. We can see here the Dow transports coming back to test a declining 50-day moving average. That's going to be probably a problem. But let's not worry too much about the price, because the RSI gives us a better view of what's really going on. And we can see that if we take a line connecting the highs on the daily for the Dow transports, yet again, we see another instrument coming back to test recent RSI highs, here being the daily. So that's one line of resistance. We can also see that if we draw another point of view, which is somewhere around here, we can see that those two lines, the red line, also coming into contact exactly where we are trading right now. Now we are having a good session, about 2% for the day. Why? Because the Dow transports are moving above 50 over the last 2 days for a nice swing to the upside. Now we are looking at the exact opposite possibility of retracing. Take a look at the hourly for the Dow transports. Number one, keep in mind that we're not too surprised with this move, is what I'm trying to say, because when we looked at the recent move here of this high, since then we can see that the market has actually traded very well, because after this move right there, Dow Transports came off the lows, which is somewhere here. We can draw a line from there, which would give us our positive uniformity line right there. And we discussed this, that every time the transports hit that level, of course, we've been getting this nice reactional trade to the upside, albeit short term. And here again, we see that this is what was taking place late Thursday. So since late Thursday at around here, we suggested that the market it wasn't a good idea to be short and take profits as best as you can. Now I am saying the exact opposite here. I am saying ignore what the market is doing and take the view that more than likely chances of a retracement are very high. So this is not where you want to go long. In fact, I think you should be looking for reasons to buy some of the short ideas that you've been looking at. We can also see here that it's coming back to test that line right there. It cannot get any more simpler, because as we walk through this resistance here, if we coil back down, back below the red line with uniform action, any coiling back below the red line with uniform action suggests that somewhere around here is where the market stalls. So there's another reason why I think the market stalls around current levels. Let's take a look at the SPX. And just to touch on the fact that the weekly is showing a nice improvement, lower lows on the weekly, nice improvement over the last, let's call it about 1, 2, 3, 4, 5, 6, about 7 months or so. So lower lows in price, improving technicals. Yes, let's acknowledge that we shouldn't be too sure that the market pulls back here, that the weekly charts are starting to look like they have some life. And so if the markets can break recent resistance that I'm discussing here, or the current resistance levels, maybe this market might have some upside. SPX daily, we can see coming back to test the top side. This blue line has been a problem. It was a problem in late January, early Feb. Coming back to test that line is a problem for this market. Also, we see that it is coming back to test the previous break level. So this break level here, coming into January of this year, you draw a line from there. You can see all these are playing out right now with the market exactly on those two lines. So resistance around here would make sense. SPX also on the hourly, just like the Dow. Simple line giving the break of December. Simple line there. Forget all the confusing data and technicals aspects, but this is as simple as it gets. A break there. You come back and use the same line. Don't overcomplicate the situation. That's a resistance there. And if we see another resistance around this level here, if we see that resistance, in other words, if we see the market coiling back below that red line showing that it is respecting resistance around here, then of course we should not be looking for long side situation, because why? The market could easily be pulling back. Because the VIX is elevated, we can be excused if we look at the 5-minute chart. When the VIX is elevated, let's say above 20, the best thing to do is to draw a line connecting lows, or is the best thing to do is use short-term charts for some directional idea. We can see here that this is the line to watch short-term to see for resistance, because yes, markets made higher highs today, but the technicals haven't followed through, so that's negative divergence. If we go on to break this blue line support on the 5-minute chart, then that's where the market starts a pullback. So watch that for a break in terms of a timing aspect. Now, of course, we're going to have to take a look at gold. And not to beat a dead horse, but if you recall what we've been talking about the past week, we refused to take the move in gold because we were suspecting this could be resistance. Of course, you know that that's been my view. It's starting to play out exactly as we thought it could play out. So maybe that, looking at gold and finding its suspect was the way to approach that situation. Take a look at the GDX coming back to show that it is potentially showing resistance where it's been stalling over the last couple of years. And so here again we see that it has failed to move above 61.8, which is the area around where the red line represents. That failure might suggest that we were correct in not taking the gold trade for now. Maybe down the road we might, but there was a lot of suspicion in my opinion. Take a look at silver. Silver came back to test that line there, which has been a problem for silver double top there in 2011. Uniform activity above the red line, back below it. That's why I would rather use the RSI. Resistance on the red line for the highs there. It's as simple as it gets. Resistance here for the highs there. And on again, even if you take this resistance close enough, resistance not quite, but now here. So that being the case, you can see that we probably did ourselves a good a good thing by avoiding that trade. It was that trade became very crowded in a hurry. I have to say I started getting emails about why we are not trading gold. Okay, all right, let's take a look here at some ideas. Take a look at DUG, and I want to just show you why I think we should still watch this. Number one, the reason why is if we suspect the market might pull back, we have to own some ETFs on there that could go higher. Now, the entry point here was at 76. Of course, we know it's been high, it's been lower, but I think what we can do here is just assume that for now it is coming back to test this 76 level, which was the previous monthly closing high, and it's trading at about 78 right now. If we take a look at the daily, we start seeing signs that maybe, just maybe around here, it might be coming to test this recent line. So if it can hold on this line, then it could start bouncing. So that's why I say we can add on or take a position here and see whether it breaks out again. But for now, this coming back to test the 50-day moving average could be a logical area to go long. Of course, always, because we don't know, we don't want to be arrogant with a 5% stop. All right, now that's one view. The other view is the hourly, and the hourly is coming back. See, this is the recent, you can take this recent low here as a reference point, and we've moved higher since then. We draw a line from there, and you can see that it was good support. Even most recent low came on that line. We are coming back, we are close to that level. So somewhere around here, I'd call it at about 78, 77, 76. I think we can still use this as a place to go long. Take a look at some other instruments, and these are just random ETFs that I know could do well if the market is to bounce, at least for a swing trade. EEV coming off this line here. You can see that right now it's doing its best to hold on that green line. Now keep in mind, this green line so happens to be just around 38.2. So if it can hold here, this is where you want to add on to that position, or at least see whether you can take up a position. DXD, and again, these are just random ETFs that are bearish ETFs. I'm just using this for some idea if you're trying to find something to own. So the green line is holding. Also, the line connecting recent RSI lows on the hourly is coming into play perfectly. If it can bounce on that line, that's where you want to add or initiate a position. Let's look at TWM, and again, coming off the lows here, or even the lows there, depending on how you want to look at it, it is coming back to test that. So this is where you close your eyes and avoid looking at the price. The price can be confusing sometimes, but this is where it began moving here during this area. And if you go back a little bit further, you can see that, so let's keep it green there, you can see that that was also the entry point during these lows here in early December. So if it can hold here, I think this is where you want to go long. All this just similar. In fact, I do not recommend the 3-time ETFs, but I'm going to add them here just to show you that this is taking place across the stock market, market charts based on the bear ETFs. The green line here could hold, and so this is similar across many of these ETFs, and also the line connecting recent RSI lows. It connects nicely with the lows here. All this pointing to this could be a logical area for support. And I should add here that the reason why we use a 5% stop, so 5% stop on everything, is you have to understand that we are making an assumption that the market will not break those two lines. That's an assumption. We don't know. The market could easily break those two lines and these ETFs might see a major drop. But if the market is to come back and test successfully, so what we are anticipating here is that these two lines hold right there. And if they hold, then that's why we are playing this to the upside, that it holds here and we get the next swing trade to the upside, and with the belief that eventually the market does break down and these ETFs eventually do break out. Take a look at one more. Similar type action, really, right there, coming back to test that line. So you're playing this on a pullback mode. If they can continue moving higher, this is where you might want to take a position. So I'm going to leave you for now. Try and rush this video to you guys so you can make your decisions accordingly. Otherwise, I'm pretty sure if I don't mention USO, I'll get in trouble. Some of you. You can see your crude oil. I guess let me take a look at. So the USO does represent crude oil, and in terms of crude oil, as long as crude oil is trading below 30.68, it is breaking down on its weekly chart. So USO continues to be bearish, representative of the crude oil market there, below 30.90 on the weekly, on the monthly, and I still think that it is pointing down. Yes, it could have swings day to day and all that stuff, but if you take a look at resistance connecting the top side, this seems like a double top on the hourly, also coming back to test this break level, and we can draw it actually from even here. Anyway, we discussed this over the weekend and we are still seeing resistance based on that hourly chart there, coming back to test that red line, which has been a problem. I'll stop right there. Maybe one more. Take a look at Sunday's video for ideas if you're trading options. I had 3 ideas, 3 stocks that are breaking down. You can see that natural gas continues to struggle here, and the weekly chart suggests that if it stays below 6.96, this is a fresh break. And if it stays below that price, it's breaking down, and the potential here for the RSI to move 30.90 would suggest an even bigger drop if and when it happens. If and when it happens, you should expect lower prices for natural gas. All right, Eric Mother, mother.com. As always, good luck, peace, and blessings. ERCS, and so it is. Yes. Ha, ha, da, blah. Mwah.